Thank you everyone for joining the BFR and SFR Investment Talk webinar. Today we will touch upon the nuances between build for rent or BFR and single family rental or SFR investing. Callers will discover how to take advantage of opportunities in this market and the different financing options available. Our hosts will also dive into industry trends and the 2020 forecast before we open up for an informative Q&A session. A few things to note: we will display occasional poll questions to help the host better gauge the audience, and everyone who joins us today is welcome to post questions at any time via the Ask a Question tool found on the bottom of your screen. The expert panelists will answer your questions at the end. To kickstart the webinar, I'd like to introduce our dual host, Ryan McBride, Chief Operating Officer at CoreVest, and Michael Finch, Principal, Founder, and EVP of SVN SFRhub Investors. Both will share their experience in the industry and unique stories that led them to where they are today. So with that, Ryan, would you mind taking it away?
Yeah, sure thing, Kennedy. Michael, thanks for joining. Also thank everybody else on the line. It should be hopefully informative. As Kennedy mentioned, we're going to be doing some poll questions throughout, so limit the multitasking. You might miss some good poll questions, and we'll take it from here. Maybe just a quick background update from me, and then I'll turn over to Michael. Ryan McBride, the Chief Operating Officer, co-founder of CoreVest Finance. We're a specialty finance company. We've been around for about 5.5 years now, nationwide lender focused exclusively on the residential investment space. I've done about 6 billion loans, financed over 40,000 properties over the last 5.5, 6 years. We've financed anything from a single family rental all the way up to larger multifamily projects on a range of different financing types, which we'll get into a little bit later, but bridge loans, construction loans, long-term financing. Before this, I had a fair amount of expertise on the owner-occupant side from a standpoint of I was a co-founder and led the acquisitions for Colony American Homes, bought the first 25,000 homes on that platform. So took a lot of that expertise and knowledge and partnered up with some other folks to start the lending platform. Michael, I'd love to hear a little bit more about your background.
Sure. Yeah. Thank you, Ryan and Kennedy and everybody for joining today. My background has largely been on the land development, brokerage, and investment side of the business. Going back to the mid-2000s, was primarily working in land investment brokerage for multifamily developers and mixed-use developers. And post-recession, got much more into the multifamily world. And then from the investment brokerage side, and then in about 2014, 2015, started realizing the opportunities in the single family space from a brokerage side of things. And my partner Jeff and I, noticed that there were no institutional commercial brokers focusing on the space. So we started putting together a platform that I'll get into later today, on what SFRhub.com and SVN SFRhub Advisors is, but we founded both of those companies, really by 2017, even though we were playing in the investment brokerage space in 2015 in the single family portfolio world. So I'll touch more on that as time goes on, but my background has largely been in investment brokerage.
Oh, terrific. Well, why don't we get started with the content? Michael, I think we're going to have you kick off on talking a little bit about build for rent and how that's differentiated from SFR rental and what you're seeing in the marketplace.
Sure. I mean, significant differences, and both obviously very stable, risk mitigated asset classes. A lot of the benefits that you see in build for rent, are new construction. You get builder warranties. You've limited to zero CapEx. Your tenants, even in the single family portfolio space, tend to average around 3.5 years. In the build for rent space, we've seen even higher tenure than that. So, it's just a quality asset. You get quality tenants because it's new construction. we like to call them residents. Actually, the residents will have a sense of home ownership moving into a new construction home, so they're more likely to take care of it. They stay longer. They're there for jobs, their kids, their schools. It's for a lot of the same reasons. Existing single-family portfolios and assets are of value, even more so on the build for rent space, just because of the new construction. And then when you deal with a self-contained community, you're going to get to take advantage of even further efficiencies and economies of scale with a self-contained community, so to speak, as opposed to having 50 homes scattered around a community, 50 homes in one. As an operator, there's a lot of efficiencies there to take advantage of. So very bullish on build for rent. A lot of big groups are coming into it, and it's an exceptional cash flowing asset class.
Right. And just to be clear, when we're talking build for rent, we're talking about single family and then also multifamily structures as well, right?
Mm-hmm. Yeah, I mean, when we do build for rent, we're referring to detached single family homes, attached townhomes. It could be condo communities. Certainly, multifamily apartment complexes are they're built for rent. They've been building for rent for 50 years. Our focus internally is specifically on fee simple single family homes. Backgrounds in multifamily, we know all about multifamily and apartments, but in our world, built for rent is true fee simple single family investment homes. That's new construction.
Got it. Terrific. And then just what do you think, from your perspective, are the opportunities for investors in this market? I know that we all see your email blasts, which are great. There's, looks like there's a lot of deal flow out there, but can you comment on the opportunities in the space?
I think they're unlimited. If you compare where multifamily was in the 80s, early 80s, there was very little Wall Street activity in the multifamily space. Fast forward to today, Wall Street is on the debt equity side of almost every multifamily deal in the country. There is a huge undersupply of rental product in this country, and I think build for rent is going to really pick up the pace on that, because you can build more affordable communities for families. It's not one bedroom apartments that are predominantly being built luxury style. I think over 80% of multifamily today is luxury style apartments. So there's a glut in the market for people that need to rent, more spacious 3-4 bedroom homes that are, relatively affordable, in that $1,500 to $2,000 a month range, as opposed to a $2,000 one bedroom apartment. So I think, given that a large majority of renters in this country prefer to rent single family homes, I think the build for rent market is poised for investors to take advantage of the opportunities there. And the CapEx, the operating expense load is less than a multifamily complex. So, the margins are greater for NOI. So I think it's a huge opportunity that's literally just getting its legs. And I think we'll see, 30, 40 years of growth in the build for rent space. Great.
We're going to pause for a couple minutes. I'm going to turn over to Kennedy real quick. She wants to offer up the first of our poll questions here for the audience.
So for our first poll question, it's just a little bit about our audience so we can get a better idea of what you are all doing out there. So we will just start out with I am either an investor, a broker, a vendor, or other. So we'll give you all the time, some time to answer the first one.
Right now it's showing more than 70% are investors. That's great. Very good to meet you and have you on this call.
Yeah, more than 70%. Wow. For our next one, we will do a quick poll on investment type. So if you are an investor, what type of projects have you worked with? Multiple selections are okay. Fix and flip, traditional rental, or build for rent.
This is like watching live election results. Pretty interesting. Yeah, a lot of swings back and forth. All right, now traditional rental at over 80%, which is a very, very great number.
Awesome.
Only 56% have voted, but we're going to switch it back to Brian so they can continue.
Yeah, I think that's pretty interesting. But it looks like we have, quite a few people online, as we would expect for single-family rental and then also build for rent. From our perspective as a lender, we started off the business on just the straight rental portfolios, as well as our credit lines. And then we've seen over the last few years, the last year in particular, a huge demand for build-to-rent properties. And I think that one of the things that was driving this, at least for many of our the folks we're working with, is there was a migration from a lot of investors that were, in a sense, acting almost as service providers, where they were helping some of the larger institutions buy and rehabilitate properties and then stabilize them and then sell them to the to the larger REITs, Invitation Homes, America Homes for Rent, and the like. And then I think as they got further and further into the model, build up their organizations, and also attracted capital, we're seeing a lot of those folks now actually owning their own portfolios and actually growing their own build-to-rent portfolios, which has actually been a nice evolution of the market. And as Michael was saying, as an investor, the newly built properties are quite interesting as an investment because you don't have as much, the CapEx and the rehab and the maintenance. And the new capital coming in the space, what we've seen has tended to gravitate more towards some of the new builds versus some of the existing housing stock, which at once upon a time was on sale during the financial crisis, but now is fully valued. And so they're looking at stepping into assets with maybe a little bit higher quality with less on-the-run maintenance that you would expect from, previously existing houses that have been rehabbed into existing rentals.
Yeah, agreed. And I think that's why you see a lot of the REITs that have, long time been in the SFR space gravitating towards new construction for all the reasons you just said. The OpEx on buying, if you're fixing and flipping a 1950s home, that's great, but buying a stabilized, clean 1950s home compared to a stabilized and clean 2018 home, the OpEx is just going to be drastically different, moving forward. So, we're seeing, from all the big REITs that everybody knows moving into this space, or at least moving towards newer construction homes, to home builders, public builders, regional builders, recognizing the opportunities in this space, some of which are even looking at saying, hey, we're just going to build, and lease and rent ourselves to hedge against, a market correction, because they're recognizing that they're not selling homes as quickly as they'd like at this point in the market, and certainly not like they have in the past, but there's a huge opportunity to build what they're already building and lease those homes and rent them, and then cash flow them, which is an opportunity that home builders have never had before. So very, very unique space.
Great. Well, one of the things I might want to do here just quickly is pivot to the financing options, because that comes up quite a bit. I know we wanted to cover that. I'll share some slides here in a minute. And then there are a couple of different interesting case studies that I'll walk quickly through just to give the audience a viewpoint on some of the things that we're seeing. And then I know we also want to talk about industry trends and what we think is ahead for 2020. So let me just do a quick share of the slide deck here, and we can kind of walk through the financing options. And I promise there's a little bit of a commercial here, but it's meant to be more informative. So I'll go easy on the commercial, more on the content. This is pretty obvious to many of you on the phone or in the presentation here. There's a lot of different ways to finance these investments. Friends and family, local banks, marketplace lenders, savings of your own personal savings. And then there's folks like us, which are dedicated to the space. Pros and cons for each of these, obviously. One of the good things about a specialty lender, though, is it's really dedicated to understanding your business. Because we are in a new phase of the rental market, whether it's existing housing stock or it's build for rent, you really need somebody that understands your business. And it can be complex if you're doing ground up construction, whether it's horizontal, vertical, stabilizing or long-term rental, you need somebody that can actually understand your business and be flexible to structure it along the ways for how you need it to marry up with what your process is. You also want to make sure that when you're financing properties or you're building properties, you have capital there when you need it. And if you're chasing your friends and family around for capital to help you execute on a contract, that's not always the best way to scale your business. So you want to go with somebody who has the capital that's proven that can be there. I think we're one of those groups. Just a quick idea of the product set that's out there. This is a very summary slide. We have a lot of different sub-products out there, but one of the things that we like to tell folks is that we really have a product for every range or every situation that comes up within SFR investment. Whether it's on the short-term side, we have construction financing and bridge loans. On the long-term side, we have 5- and 10-year portfolio loans. And then what's been really interesting to hear as of late is to marry these two concepts in the build-to-rent space. So what I mean about that is really a one-stop solution where we can provide the construction financing to help folks do the horizontal and vertical portions of the build-out. We can then bridge those assets while they're being stabilized, and then once they're stabilized, occupancy is where it needs to be, typically 90%. We can also do the term loan financing, so there's really no uncertainty when it comes to financing a project, really from raw dirt all the way to the finished product. So that's been a lot of fun to work on, and we've had quite a few opportunities to work with folks here over the past 12 to 18 months on build for rent. A couple of examples here, which are kind of cool. This one in particular is about a $23 million loan. It is really kind of ground-up construction of a 178 unit community, Huntsville, Alabama. What's cool about this one is it's modular, and you have these properties being built. They're prefab, they're delivered to the site, they're assembled on site. So when you look at the cost of going vertical, it's about 15 to 20% less than your typical kind of sticks and bricks construction. And then if you look at the cycle times, it's almost twice as fast. So we're expecting to see a lot more of this type of product, a lot more of this type of strategy for build-to-rent going forward. So this is a great loan. We're about halfway through it. We estimate by the beginning of the new year, we'll have this community fully built out and then be doing a term loan for this borrower.
Beautiful community.
Yeah, it's pretty cool, right? And the build quality is pretty amazing. Sometimes modular or prefab gets a bad name, but I think with the technologies that are coming to play in the market, and then the infrastructure, the investment that's been put in that space, these truly are homes that many people won't have any idea that they were modular versus the normal sticks and bricks.
You can't tell, and we're working with a couple pretty significant modular groups. I think will make a big splash in the coming years. Very excited for all the building technologies that are coming, and it's a long time overdue.
Yeah, and it's a game change, and I think you're going to see it on greenfield sites like this, and then you can also see it on infill sites with some really kind of clever, creative ways to approach that market as well.
Absolutely.
So this next one is a pretty big loan, $45 million plus. This is a group that prior to the financial crisis was a fairly large production home builder. Once the crisis hit, the need for rental housing went up. I should say also the demand by owner-occupiers went down. They got into the rental home business and now have several thousand homes. And this is one slug of their portfolio that we're financing for them. And what we really did here is we provided the bridge loan to help them get stabilized and get the occupancy where they need to be. And then we did a term loan on the back end for the long term. I think in this case it's a 10-year financing. So these last two deals are reasonably sized deals. I want to point that out. But at the same time, we'll go down to $3 million for a build-to-rent loan, and then as low as $500,000 for an SFR loan. So we have a lot of flexibility in terms of what we're doing here.
That's wonderful.
And then just the last one I'll just point to is, kind of how we started, kind of bread and butter. This is, existing housing stock in, I believe it's Columbia, South Carolina. Good-looking houses, and it's kind of the typical model that we saw and continue to see a lot of folks pursue, which is buying existing housing stock, rehab those assets, stabilize them, and then put them into a long-term term loan and just, live on the cash flows. And so this is a good example of an investor that has done just that. They actually bought these homes, did rehab using one of our bridge loans, and then this is a term loan we did recently for this group. I think start to finish, we closed this deal in under 30 days. So again, the model works well, and it's there for all sort of opportunities when it comes to financing these portfolios, whether it's existing housing stock or build to rent. And this is a little bit of a commercial. The only thing I'll say on this, because I think I've hit some of these stats, is, we have greater than 50% repeat business, which I think is, a true testament that we know what we're doing, at least to half the people we're working with. But I think what we show is there's debt is scalable, people have access to capital, and helps them grow their business. So with that, I just want to leave everybody with there's ample capital out there to finance these situations, and we're very eager to work not only with Michael and his team on deals that are out there in the market, but if you're an existing investor and you have capital needs, let us know. So Michael, I was thinking one thing we could turn to, because I know people are interested in it just based on the questions, is what do you see in terms of trends coming up? What do you think's ahead for 2020 and beyond?
Well, I think, again, I think we're going to see huge growth in the build for rent space. The number of capital groups, private equity, multinationals that are literally flooding the space right now with hundreds and hundreds of millions of dollars. I'm going to suggest that there's probably in the build for rent space, 2020, we'll see 75,000 homes built, purpose built for rent. Maybe more. I mean, we're working with some groups now that, one is planning on doing 10,000, just on their own, to builder. And that's just one builder. And we all know that a number of them are going into the space. So, I think it's going to be a real eye-opening year for a lot of the investors. And I know it's one of the big concerns too for groups out there, that are trying to find comps and understand how build for rent works. I think after 2020, there's going to be a lot more comfort in seeing how much was done and how the space is really proving itself. So I'm very bullish. I think it's going to be a huge, huge year for build for rent. Right.
Yeah, I think we're already seeing it. I think that there was a lot of buzz around it. I think a lot of people go to the IMN conferences and other conferences, and there was some early buzz on this maybe a year ago, but it's one of those segments of the market that I think has actually lived up to the hype. I mean, I think there's a lot of activity there.
Yeah, I 100% agree. And as I said, I mean, we're boots on the ground every day. We are constantly underwriting. Developers are coming to us. Builders are coming to us. We're working with them to reverse engineer and really kind of determine if any site is a good site for build for rent and why. But it's going to be 2020 is going to be a huge year for build for rent.
Right. Yeah, I think in terms of the overall industry too, it's fascinating to see how just the overall rental industry has evolved. There's a real ecosystem now in terms of vendors out there. There's obviously financing groups, and so it'll be interesting to see how it continues to grow. I think we talked about a couple themes that we're seeing, which is the use of alternative materials, the modular construction. Technology seems to be getting better, whether it's for property management or for acquisitions or for further defining build costs. It's a real industry now, and it's interesting to see how it moves forward.
Yeah, I think the efficiencies that are being built in on all sides are going to maximize the potential for build for rent. I think one of the most interesting things about build for rent is, and because we're SVN and our background was multifamily, we're seeing lots of multifamily investors starting to come into the space aside from private equity groups and some of the larger multinationals coming into the space. But being able to, if you're a multifamily investor or you're a property manager, or you're a home builder, build for rent is a new avenue as well for the life cycle of your tenants. So if you own both build for rent and multifamily in a community, well, now you've got opportunities to move your tenants out of that one bedroom apartment and into, a community of single family homes that you manage. And, or if you're a home builder, now you have an opportunity to show your tenant, when you've built a community for rent, once they're ready to buy, they're used to you and your product, and you can move them into a new home for sale as well. So I think there's a lot of opportunities for everyone that's in the multifamily and builder and cash flow industry to take advantage of life cycle of tenants, long-term tenure, mitigated risk, big opportunities.
Got it. So, Michael, I know we'll just hit pause here right now because I'm seeing a lot of Q&A build up, but I want to see if you wanted to share any slides with the group before we go into the Q&A portion here.
Sure. I can. I think we've got about 7 slides just for everybody here. Give you a quick rundown on our companies here at SVN, SFRhub Advisors, and SFRhub.com, and just chat a little bit about build for rent and the industry here. Give me one moment. Can everybody see that?
Yeah, looks good.
Okay. So SVN, SFRhub Advisors, and SFRhub.com, we are the nation's largest and top-ranked SFR and BFR build for rent platform today in the country. I think this is a telling slide for build for rent and just single-family investments in general. This is the graph you see on the right there was put together by the U.S. Census between 2006 and 2016. There was a nearly 24 million population growth in the country, and 23 million of those were renters. So, 97% of the population growth in those 10 years were renters, not homeowners. That is a staggering number that I think is telling for all single family and build for rent investors. Huge need for single family homes. I think John Burns, Real Estate Consulting, indicated about 5 or 10% of all new build homes will be built for rent. That is, I think that falls well within that 75,000 number that I had mentioned earlier. BFR buyer investor benefits, lot of benefits here. If you're buying, you get a higher return compared to other CRE segments. That's including multifamily, retail, office, all the typical stuff. You've got, when your tenants are taking care of their water, sewer, trash, you have very minimal common area electric like you do in a multifamily, depending on the amenities. You may or may not need pools and gyms. So those utility costs come down. You'll see substantial appreciation in new build homes in the right markets, and tenant lease rates are typically 7 to 10%, sometimes even higher, depending on the area, in a self-contained, professionally managed new build community, as opposed to just homes maybe down the street that's a one-off rental. So pretty significant opportunities. And then with groups like CoreVest coming in to bring better financing options, it's really opening the door for a lot of the commercial real estate investors that have been kind of watching the single family investment space on the sideline, because they're usually familiar with better debt terms and then have been offered in the SFR space. But now that's all kind of coming full circle as the asset class has been institutionalized. From a builder BFR inventory access, and there's a number of ways to do build for rent. We work with some of the public builders that just load up standing inventory on our site at SFRhub.com. So those could be new construction homes scattered around in MSA. We can work on, self-contained communities of build for rent, where a buyer can purchase a whole community as the builder is building it out. This can be done through pre-commitments, no different than how multifamily has always been done for many, many years, where oftentimes there's a forward commitment to purchase from the multifamily builder developer. Build for rent homes can be closed in tranches. It can be closed at lease up. It can be closed at stabilization. Number of ways to do it, and a lot of opportunities. Investors have different criteria. They can purchase maybe 5 or 10, 20% of a community. They can purchase standing inventory within communities, or they can purchase a whole community. So it really kind of depends on on what that investor is looking to do. And at SVN SFRhub Advisors, we can certainly help investors with a more programmatic approach if they're looking to build scale in communities. So we're working with developers and builders all over the country and in just about every market. So, for those groups that say, I want to own 500 homes, in Dallas, Texas, in the next 2 years, it's a heck of a lot easier to aggregate and build and buy, 2 communities or 3 communities of 150 homes apiece, where you can take down homes, say, 10 homes at CO at a time, lease those homes. The builder is blowing and going, so each builder can finish 150 home community in roughly 12 to 15 months. And the buyer is now aggregating homes very quickly, as opposed to the old SFR model, where unless you're buying a portfolio of 500 homes in a market, most people have been aggregating onesie, twosie at a time. So the build for rent is a great way to, put a programmatic approach together to scale. And we can work with both builders and investors to help accelerate that, to, pinpoint target markets, and put together the financial projections. We do a lot of work with builders who may come to us and say, hey, we've got this community that we were planning on building for sale, but we think it might be a great build for rent opportunity. In those cases, we'll work with them, and maybe they're building 75% 4s and 25% 3-bedroom homes. Well, in a for rent model, that may be different. Maybe the best model is 75% 3s and 25% 4s for the market, depending on what's in demand. We get pretty granular in our feasibility and research when we're working with builders on a build for rent deal, and we essentially reverse engineer from a cash flow standpoint back, and work with the builder to bring down finish levels, elevations, and really maximize the cash on cash return that is of utmost importance to buyers and investors in the market. A lot of the advantages for a builder, that also is an advantage for a buyer, because some of these advantages get passed on. So, reduced builder warranty expense. Builders can double or triple their production in a market doing build for rent. They can accelerate their build out and disposition when they're working with some of our investors or you guys out there that want to pre-commit to buying. Being able to build something out faster, obviously, reduces their land carry costs. They don't have the typical marketing and staffing and commissions that are associated with for sale product. So, if it's a $250,000 retail home, maybe there's an opportunity for the investors to take advantage of some of the savings that a builder will get by not going for sale and going, selling to an investor for rent. They can build those communities out in literally 3 times the amount of time. To work with CoreVest on interim financing, which, a few years back didn't really exist, but now the industry is there for build for rent. It's just, for a lot of reasons, for a builder, it's a huge benefit to get into the build for rent space, and a lot of those benefits get passed on to the buyer. So a buyer isn't necessarily paying what might quote unquote be considered retail, because some of those builder savings are being passed on to the buyer. So the builder wins by selling homes quicker and building homes quicker. The buyer wins by buying at a price that he can hit a stabilized occupancy at a net return that's beneficial for him, and then they can cash flow for a number of years, or maybe turn around and sell that stabilized operating cash flow. If they've stabilized at, say, a 7.5% or a 7% cap, well, they can probably turn around and sell that to a larger, pension fund or a multifamily investor that's happy with a 5.5 cap. So a lot of opportunity to take advantage of the arbitrage in those cap rates once you've leased up and stabilized a community. A little bit about SVN, SFRhub Advisors. SVN, many of you probably know, used to be called Sperry Van Ness. We are the 6th largest national CRE firm, commercial real estate firm in the country. SVN in aggregate did about $12.1 billion in gross transactions in 2018. We've got 200 offices nationwide and 1,600 advisors and 500 submarkets. So we've got boots on the ground everywhere for local intel, which is great. SFRhub Advisors specifically, which is an SVN franchise, is one of the only offices in SVN that was granted the entire country as its primary market, because we are the only brokerage, commercial brokerage that I know of in the country that is 100% focused on the single family investment and build for rent investment asset class. We have an SFR product council that we work with agents across the country within SVN to get them educated on how these deals work, turn up deals, for our investors, for our buyers, for our sellers, and introduce them to the SFRhub.com platform. SFRhub.com being a data evaluation and digital transaction site. So we are not just a listing or an auction site. We are literally a full portfolio transaction site where buyers can come on, look at our listings, look at the data, put together their financial modeling, and then submit offers directly to the seller through the digital portal. And we launched our technology platform, SFRhub.com, in December of 2018. And we now have $1 billion worth of available listings on there, both in the build for rent and the single family investment space. So that is a quick overview on what we really offer here, which are 3 things: increased acquisition and disposition profitability, increased national deal flow for both buyers and sellers, and the first intelligent and structured valuation and decision data, because we really go through a full data audit on every portfolio we look at before we value it. So we are really cleaning and verifying about 25 to 35 points on every single home before we ever hit the market. So that's a quick overview on our 2 companies. And let me get out of the screen share here for you, Ryan. There we go.
Look, that was great. I appreciate that, Michael. I know the audience does as well, given the number of Q&A questions that are coming across. Maybe before we jump to Q&A, I know we wanted to go through a couple more survey questions, so I'll turn it over to Kennedy to do that, and then we can get into Q&A right after that.
Sounds good.
Perfect. All right. For our next poll question, this one will be based on investor experience. If you are an investor, how many projects have you completed? So we have 0 to 5, 6 to 15, 16 to 50, or 50 plus. And we'll give you a couple seconds to answer that. All right, so it looks like 44% of you have done 0 to 5, and we go to 22%, 6 to 15, 19%, 16 to 50, and then about 15% of you have done 50 plus.
Great.
Okay.
We have one more poll question coming through. Are you currently looking for an investment property? Pretty straightforward, yes or no.
And if I can jump in there for any of you investors out there that are looking for an investment portfolio or build for rent deal that are not on SFRhub.com today, please register and make note that you had we're on the CoreVest podcast, and we'll get you through the system and certified so you can see all of the deals on SFRhub.com.
All right. So the vast majority of you are looking for investment property. That's good to hear.
Well, sounds like people came to the right place then. So Okay. Kennedy, were you going to handle Q&A, or did you want me to go through the list here?
Yeah, we can jump into Q&A right now. So with the interest of time, we won't be able to get to probably all of the questions. We did get a lot, but we're going to try to get to as many as possible. And then for those that we don't answer, we can try to get an email response to you as well from our panelists.
Yeah, and Kennedy, if I may, and I'm kind of thinking off the top of my head here, but depending on the questions we don't get to, whether they're for Ryan or myself, but maybe we can all get together, put together answers for those questions and then share them with all the participants that joined.
Absolutely, yeah, that's definitely something that we can do. No question left behind. All right, so for our first question, Roy asks, how can I find out the value of a property if I'm building a 20-unit apartment building? How do I find the cap rate?
Ryan, I can take that just from my multifamily experience if you want, but I know you guys are doing a lot more financing on multifamily than we're playing.
Sure. Yeah, sure. Go ahead. That's all you.
Yeah. When you're looking at a multifamily deal, I would absolutely speak to the local brokers in that market that are selling multifamily. They're going to have the best insight into where, whether it's A, B, or C class, what's a B class 20-unit apartment unit, trading for cap rate wise compared to a C class, D class, or A class. They're all going to be different, of course. But I think, the local brokers that specialize in multifamily, there are lots of them out there, and I would find, kind of the 2 or 3 top sellers in that market, and they will be able to give an ideal answer very quickly. And depending on what market you're in, we've got multifamily specialists in 500 markets around the country, so I can make those introductions to our SVN multifamily specialists and make sure that you get the info that you need. And hopefully that answered the question. If I missed part of that question, I'll come back to it.
Yeah, definitely. Thank you, Michael. For our next question, Arthur says, for Ryan, do you offer a product like a HELOC on a property I own outright?
Yeah, so I responded, in the chat module here, but I'll have to go through this again. So we offer credit lines for folks, and those are great to acquire assets or to refinance assets. So in that respect, they're similar to a HELOC. They give you the flexibility to use capital kind of on the fly to execute your business plan. They're different from HELOCs though, because we only really allow our loan on a given property. So HELOCs are second liens. We don't do that. So if the property is unencumbered, then we can put leverage on it, and then you can use the proceeds, as you need. But we can't do that with a property that has an existing mortgage on it. So happy to talk in more detail on it. Again, the credit lines give you a lot of flexibility, but it's not quite like a HELOC where you can put it on, an existing mortgage, and then we also have a bit more restrictions in terms of what our capital is for. You can't take one of our loans out necessarily and use it to go buy a boat and do other things. But again, we can talk more about that live.
Great, perfect. Thank you, Ryan. So our next question, Noel would like to know, what are your thoughts on the BFR that is sharing parcels in order to get the MFR financing?
Yeah, I'll take a quick stab at this, and Michael has any commentary, please join in. We're seeing both strategies where you have a single parcel with multi-units, which is certainly eligible for multifamily financing, on the agency level. We're also seeing it where each asset has its own individual parcel, which often is not eligible. And look, we think that having multiple financing options as an investor is a good thing. So we certainly are amenable for folks that want to go the MFR route with the agencies. Oftentimes it comes down to execution, in terms of timing. It comes down to, the structure of the loans. We think our products are very compatible, and also I think the timing tends to be pretty quick in terms of what we can deliver. So again, it really comes down oftentimes to what the project demands in terms of whether it's sharing parcels or individual parcels, and the zoning and all those kinds of things. And so ultimately, what we like to tell investors is, come up with multiple financing strategies, and we're definitely going to be in the hunt for at least one of those.
Yeah, I don't have much to add to that. I guess I would say on the the parcel that contains a single family, if they're all together in each lot within the adjoining multifamily parcel is all together, it's going to help on the financing, opposed to the additional fee simple single family parcels next to the multifamily being somewhat fractured will make it a little more challenging, but there's obviously financing out there for everything.
Great. So our next question comes from Jenny. This one is specifically for Michael. What are the advantages and disadvantages comparing for rent SFR versus multifamily?
Well, I think if you're going to compare it to a typical apartment complex as compared to a scattered single-family portfolio, I guess the biggest advantage for the apartment complex is that they're all together. And that is something that, 10 years ago, investors would have always argued as the number one advantage. Fast forward to today, where investors, specifically the institutional groups, the IHs, American Homes for Rent, Tricons, Progress Residential have proven that it is possible to scale and be efficient at operating scattered single-family homes. I think that stigma is now not there like it used to be. So I think the biggest advantage to owning a single-family portfolio over a multifamily is the quality and tenure of the tenants. In multifamily, the average tenant stays for about 1.15 years. The average tenure for a single-family tenant is 3.5 to 4 years. So right there, you're spending less, every year on turns. People are there because they've got jobs, their kids go to school, whatever that reason being. It's much harder to pick up and move a 3 or 4 bedroom home. And then if there's any type of market correction, the single family historically has outperformed every asset class in the country. And if anybody wants to reach out to me, I can share an article that was put together by an analyst who compared the single family residential investment space from 1976 to 2017 and compared it against all multifamily CRE and stocks and bonds, and it literally outperformed all of them. So the single family investment space is hands down the most risk mitigated and stable asset class in the country. And for those that don't have maybe the right team in place to manage a single family scattered portfolio, we've got all the necessary alliance members to put you in touch with, such as CoreVest for lending. We've got property managers that we can introduce you to, general contractors that handle single family homes. So I think the advantages of single family portfolio certainly outweigh multifamily, but multifamily is still a great asset class with obviously it's seen tremendous growth in the last 10 years. But I think from a risk and stability factor, nothing beats single family investments.
Great. Thank you, Michael and Ryan, for your responses on that one. Our next one comes from Eugene, specifically for Ryan. Will you ever offer interest-only loans at least for the first 5 years? Could be on 5/1 or 7/1 instruments.
Short answer is yes. The long answer is yes. We have interest-only options as well as amortizing options. It just really depends on, what's best for the borrower, but happy to talk through those options live.
Perfect. So then maybe we can get in contact with Eugene.
Yep, let's do that.
Great. So our next one is from Jason. How do you evaluate a builder development partner navigate the risk involved in a 100-plus home project, and how do they make money at affordable price points given the pressure on the builder industry GMs?
That's a good question. We, on our side, we don't get into analyzing what a builder's cost is. So when we work with a builder that brings us an opportunity, we look at it from, as I said earlier, we reverse engineer the entire project from a cash flow standpoint and what we think a buyer will pay for the deal. Obviously there's lots of constraints on builders today, limited availability of land, increased costs of construction, materials, lack of labor. Everybody knows all the challenges that are in the building industry today, by which build for rent is I think a big solution for. It's really up to the builder. It's hard for me to answer, well, what's gonna be the benefit for the builder, because we don't get into all their internal costs, but we do share with them what we believe the homes can rent for, what that cash flow looks like, what that disposition sale looks like, and it's really up to the builder at that point to determine if it makes sense for them to go that route.
Yeah, I would just tack on there. We have a somewhat similar view when we underwrite portfolios or build to rent projects. We will look at the project merits. We kind of look at the cash flows from the projects. We spend a lot of time just looking at demand drivers, making sure that those projects are in areas that people want to live. There's proximity to employment, proximity to transportation. We want to make sure we look at rental comps that we can get solid on what the revenues are going to be. And then we'll obviously look at the track record just to make sure that the builder can execute on the plans laid out. That's obviously something that's key. You obviously don't want somebody who's tried it true at building big multifamily projects in the Northeast, and then now they're going to start doing individual SFRs in the Southeast. It's their first rodeo. Sometimes that's not always compatible, right? So there's a lot of things to look at just to make sure that the project is feasible and it's going to cash flow like everybody expects. Yeah.
Demand drivers, like you mentioned, Ryan, not atypical to multifamily when you're doing a build for rent community. I mean, there's nothing more important than jobs. School, I would say, is second. And then surety of the deal. I mean, that's a big thing both for a builder and a buyer. The buyer wants to know that the builder has the wherewithal to complete the project, of course. They don't want to get stuck holding 50 out of 100 homes because the builder can't continue building, and vice versa. The builders want to know that the buyer has the wherewithal to continue purchasing homes.
Great. So we have time for about 2 more questions. And as mentioned earlier, we will follow up with all of you that did ask, but we will only answer 2 more live, and then we will go to our final poll and wrap up. So for another question from Bruce, do you think that rent to own has any application in the space that you were talking about, or the financing being provided? For a builder, this offers a lot of options. It would be great to have the flexibility to sell at best time, hold rentals, etc. Is the main obstacle the prepayment penalty?
I'm trying to, I think that for builders, they want flexibility, and I think that we've seen them, take a couple different strategies, build products, sell to owner occupants, hold back some of the homes, and then do build to rent, so they rent those assets off. I think in terms of, it all comes down to trade-offs, right? So if you want the absolute cheapest cost of capital, the best way to get that is to lock into particularly in this environment, a long-term loan. And that's generally defined as a 5 or 10-year loan. If you're not quite sure what you want to do, you can certainly do a bridge loan, which typically goes to 2 years, sometimes can go a bit beyond that. That's going to have a higher coupon, but there won't be a prepayment penalty. So you're going to have higher short-term financing costs, but you'll have that flexibility. And the difference in rate can be meaningful, I think, on a long-term loan. Now in this market, you're probably looking at something for a low value loan, call it 60 or 65 LTV, something that starts in the low 4s, can go up to kind of high 5s, low 6%. And I think with it's going to have a prepayment penalty to it. But if you look for a short-term financing credit line, for instance, you're going to be something that probably starts with a 7 in terms of a rate, but you're not going to have the prepayment penalty, so you're going to have more flexibility there.
Great. All right. So for our last question, which markets, i.e. states, are you thinking the build-for-rent model is working the best in?
I'll take. I mean, Ryan, jump in as well. But most of our activity is in the South and the Southeast. We are active in the Phoenix and Vegas markets. But I would say predominantly the South and Southeast is where we're seeing a majority of build-for-rent taking place. And then we have been moving a little bit into the Midwest as well, into some more secondary markets where there's just always, I'm from the Midwest, but people rent forever in the Midwest. But yeah, we've seen some stuff in Des Moines, Kansas City areas, but by and large, Texas, Georgia, Florida, the Carolinas is probably a majority of our build-for-rent activity. But it works everywhere. I mean, we're working on a deal in Portland right now. Many wouldn't think it would work in Portland, but the numbers look great. So we just have to take every deal by deal and we'll underwrite it and take a look. But I think it works everywhere, where there's jobs, schools, growth.
Yeah, I would agree with that wholeheartedly. I think that where we look at where we're lending money, where our clients are, it's the Southeast, it's Texas primarily. But as Michael said, it works everywhere. What I would say is it's not necessarily one size fits all. I think some of the build-to-rent projects you see in the Southeast, in Texas, there's more land available, and so you tend to have kind of the single-story, maybe be simple, just the individual assets on parcels, and maybe they're subdivisions that major home builders once owned, or it's kind of infill there. We're seeing projects that look very different in urban areas. Portland is one that was mentioned. We're even seeing opportunities in LA and the Northeast. They look very different, but it's for infill sites that might have been cleared, and instead of building 70 or 80 homes per se, you might be building 10 or 15, and it might be repurposing some existing inventory, or you're getting permits to add more density, and we're seeing a lot of opportunities there. So not as many, obviously, on a pound-by-pound basis, but certainly there's opportunities all over the country. Yeah,
and everything is a function of rents. So obviously California. Some would argue that it can't be done there. I disagree. We've seen, opportunities where it would work. But by and large, if you just wanted to take a broad stroke on averages, build for rent works really well between 175 to 275,000, kind of as the range of pricing on homes. Now, the more infill you get, can it work at 400 grand a home? Yes. But less likely. The rents really have to be there. Have we seen in Nashville, for example, in a CBD, we saw a 500,000, attached product work very well, but it was downtown CBD district. They were getting $3,800 in rents. So it's all a function of rent. But I honestly think it can work anywhere. What can the builder buy the land for? What can they build for? What can it rent for? These are all factors that come into play. But, if the cash flow is there, it's certainly a workable project. And we're happy to look at any deal that anybody has to help them underwrite it and let them know our thoughts.
Great. So thank you, Ryan and Michael, for answering all those questions. As previously mentioned, we will get to all of you that ask questions, but we are a little short on time. So before you hang up, thank you for joining. And we would kindly ask you to answer just a couple more poll questions so that we can better gauge our audience for next time, as this will be sort of a series. So for our next one, it's how do you currently source investment properties? Once again, multiple selections are okay. Brokers, trustee sales, MLS, off-market, or other. All right, so it looks like 58% say brokers, 18% say trustee sales, 60% MLS, 63% off-market, 30% other. So a little bit of a mix there. Our last one should be popping up right now. What kind of lending sources are you currently utilizing? Bank, private lending, all cash, or friends and family?
Very eager to see this one. Where's the drum roll, Kennedy?
All right, so 45% say bank, 33% private lending, 14% are lucky enough to have all cash, and 8% friends and family. Great.
Terrific.
Final poll of the day.
We have one more for you. How will 2020 compare to 2019 for investment opportunities? Do you feel it will be the same, better, or worse? All right, so most people, 52%, are saying glass half full, better.
All right, back up the truck, everybody. Looks like we have a bunch of optimists here.
Awesome. Well, once again, thank you everybody for tuning in today, and stay tuned for episode 2, which will be coming soon. Thank you, Ryan and Michael, as well, our expert panelists for this one.
Thank you, Kennedy, Ryan, and everybody.
Thank you, Mike, Kennedy, everybody else. Have a good day.
Bye-bye.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit CoreVestFinance.com.